The idea of negative interest rates may seem counterintuitive, if not downright crazy. In a world where lenders make money by charging their customers interest, why would they be willing to pay someone to borrow money? In this case, the lender is the one taking the risk of defaulting on the loan. As strange as it may seem, there are times when central banks run out of policy options to stimulate their nation's economies and turn to the desperate measure of negative interest rates. An interest rate is the cost of borrowing. Financial institutions charge borrowers interest when they lend money. So, taking a car loan, mortgage, line of credit, student loan, credit card, or any other debt means you'll pay interest. This means a 2% annualized interest rate on a $100 loan means that the borrower must repay the initial loan amount, plus an additional $2 after 1 full year. Banks and central banks charge interest when they lend money to other institutions too. There are cases when interest rates dip below 0%. These are called negative interest rates. This happens during periods of deflation. During deflationary periods, the value of a nation's currency rises because of a drop in prices. Negative interest rates are an unconventional monetary policy tool. They're also fairly new. Cash deposited at a bank yields a storage charge when interest rates dip into negative territory. So, depositors don't earn any interest income when they save their money but pay money to do so. By charging European banks to store their reserves at the central bank, the policyholders hope to encourage banks to lend more. Negative interest rates should help to stimulate economic activity and stave off inflation. However, some policymakers remain cautious about resorting to them because there are several ways they could backfire. Consider what happens with certain assets like mortgages. These loans are contractually tied to the prevailing interest rate, which means that negative rates could squeeze profit margins to the point where banks lend less. Negative interest rates occur when prices begin to start dropping to low levels as the value of a nation's currency increases. At these times, central banks may resort to negative interest rates. The purpose of negative interest rates is to fight deflation, discourage people from hoarding their cash, and encourage lending by financial institutions. When interest rates are negative, lenders pay borrowers for holding debt. This means that someone gets paid interest for holding a loan, such as a mortgage or personal loan. As such, banks lose out while borrowers benefit. Savers, on the other hand, lose out. That's because it costs them money to store their cash at the bank. This means that they don't earn any interest income when they save their money.